Hi there, my name's Gordon Farragher. This brief recording looks at the corporation tax implications of being involved with a group of companies. So here's a random looking group. We've got A Limited owning 90% of B Limited and 60% of C Limited. Now, from an accounting point of view, you hopefully are aware of the fact that each company individually would have to produce their own set of accounts. A, B and C completely separate, they're separate legal entities, they would each prepare their accounts. However, from an accounting point of view, because A controls B and C, they would also have to produce consolidated accounts, which basically treat the three companies as a single entity. Now, from a tax point of view, it's quite different. The tax is done for each company separately. You've got a corporation tax comp for A, then another one for B, another one for C. The consolidated accounts are completely irrelevant for tax. So things like goodwill on consolidation has no relevance for tax whatsoever. So we start off by saying ignore the fact that they're in a group. So what are the group implications? Well, it depends on the extent of ownership. Where one company owns at least 75% of another company, so in my little example that is A and B, then you get two implications coming in. You get group loss relief and group gains. Now, if you want to get into the real fine detail, there are some technical differences in the definition of a group for group loss relief and a group for group gains, but most of the time they're going to be the same. Group loss relief, in simple terms, just says if one of A or B make a loss, and group loss relief applies to pretty much all losses except for capital losses, they can pass the loss to the other group member, and the other group member can set the loss against their total taxable profits of that same period. Then we have group gains that says if either A or B sells an asset and makes a capital gain or a capital loss, then they can reallocate the loss to any other member of the group. And also, if a capital asset passes between two companies in the same gains group, it passes at nil gain, nil loss. Now, on the face of it, C Limited can't participate in any of this because it isn't 75% owned. However, there is a little thing that can kick in for C Limited. If there are other companies owning at least 15%, the significance there is you have to have companies owning in total at least 75% of C, then that opens the door to consortium relief. In which case, if we had a consortium, if C made a loss, A would be able to claim up to 60% of C's loss to set against A's profits. Now, what other implications have we got? Well, where you have a 51% group, and here A, B and C are all in a 51% group, well, there are two main things to watch out for. When you're looking to see whether each company has to pay tax by instalments, you compare their augmented profits with the profit threshold. The profit threshold is normally 1.5 million, but that has to be divided by the number of companies in the 51% group. So in this case, that would be 3. So for each of A, B and C, if their profits exceed 500,000, they would have to pay quarterly instalments. The other implication of being in a 51% group is the ability to form a VAT group. Ordinarily, each of A, B and C would register separately for VAT and do their VAT as separate entities, but if they want, they could form a VAT group, which means they would only do one return for the group, and any supplies inside the group are disregarded for VAT. The VAT grouping is a choice, it's flexible, you don't have to do it. If you do it, you can bring some companies in, you can leave others out.